Hi everyone, Alex from Summerhill here with another quick update. Today I wanted to cover three topics. A quick reminder about what happens to managed fund unit prices at this time of the year, an update to the federal budget tax changes, and some important superannuation changes that commence from 1 July. Firstly, a quick reminder, if you hold managed fund unit prices typically drop from the 2nd of July as year-end investment income is distributed. This means you may see a temporary decline in the value of your portfolio from today until distributions are paid into your investment account, usually around mid-July. Moving on to the federal budget, back in May I recorded a video explaining the proposed tax changes announced by the government. Since then, we've seen some important progress. The first round of legislation implementing a number of those measures has now passed both houses of Parliament. Today, I'm going to cover the most relevant, being changes to capital gains tax and negative gearing from 1 July 2027, starting with capital gains tax. From 1 July 2027, the current 50% capital gains tax discount will be replaced with an inflation indexed cost base for future capital gains. For assets in a capital gains tax position, rather than simply applying the new rules to the entire gain, taxpayers will effectively separate the gain into two periods. The growth up until 30 June 2027 will continue to receive the current 50% capital gains tax discount or be capital gains tax free if that asset was acquired before 20 September 1985. From 1 July 2027 onwards, uh, growth will instead be calculated using the index cost-based method. To do that, you'll generally either need to determine the market value of your assets as at 1 July 2027, or alternatively using an apportioning formula. We're still awaiting further information about that particular method. Exactly which approach produces the better outcome will depend on the particular asset, how its value has grown over time, along with the specific details of the apportioning formula when those details are released. The legislation has also confirmed that the proposed minimum 30% tax on capital gains will apply. Importantly, this only applies to gains calculated under the new indexed method from 1 July 2027. The minimum 30% tax on capital gains won't apply to individuals receiving certain government income support payments, such as an age pension, disability support pension, or job seeker. These changes apply to all classes of capital gains tax assets, not just residential property. However, new residential dwellings and affordable housing are exempt and can choose between the 50% capital gains tax discount or using the indexation method. In practice, strategies that will matter for managing capital gains tax are likely to include using available capital losses, carefully timing asset sales, making sure any available exemptions and concessions are claimed, record keeping, given the importance of the 1 July 2027 valuation date, and considering whether to hold future growth assets personally, jointly, in a trust or a company, or through superannuation. For example, the capital gains tax rules for super funds remain unchanged and operate under a different operate under different tax rules. So for some, it may offer far more concessional and better environment for future growth assets. Navigating these changes to tax legislation is complex. Your personal circumstances and goals will shape the strategies most appropriate for you. We are still awaiting further detail of the legislation and will discuss how it impacts you personally at your next planning meeting. Moving on to negative gearing, as previously announced from 1 July 2027, negative gearing will generally be restricted to newly constructed residential properties. You can continue to negatively gear if the residential property was acquired before budget night on 12 May 2026. Established residential properties purchased after budget night will still be able to claim rental losses. However, those losses will generally only be offset against future residential property income or capital gains. Importantly, these changes don't apply to other investment assets such as shares and exchange traded funds or commercial property. One additional measure that wasn't originally announced on budget night is the provision of new self-managed super funds, limited recourse borrowing arrangements for real property. Self-managed super funds will not be able to enter new limited recourse borrowing arrangements in real property, except where that asset qualifies as business real property. This will commence 45 days after royal assent. Importantly, this isn't retrospective. Existing borrowing arrangements are expected to continue, and contracts entered before the legislation commences are also expected to be protected, although we are still waiting some further final detail. Now moving on to trusts, as some of you may recall, the government is proposing a minimum of 30% tax on trust distributions, which originally included testamentary trusts. Now these are trusts established through a will. The government has since confirmed that genuine testamentary trust established through a will are expected to remain outside of these proposed minimum 30% tax changes rules. That's positive news because testamentary trusts provide valuable asset protection and estate planning benefits. So it's great you'll still be able to receive these benefits without losing their important existing tax advantages. We are still awaiting further consultations to come, particularly around discretionary trusts. So we'll continue to monitor these developments and keep you updated as more information becomes available. Turning now to superannuation, there's several important changes that commenced from 1 July. Firstly, the concessional contribution cap has increased from 30,000 to 32,500. This is the amount you can add to super on a pre-tax basis. If you're currently salary sacrificing into super, it will be important to review your arrangements to ensure they're still appropriate under the higher cap. The non-concessional contribution cap has also increased to 130,000 or up to 390,000 under the bring forward rules, subject to your total super balance. This is the amount you can contribute to super on an after-tax basis. These higher limits create additional opportunities to move more wealth into the tax-effective super environment. The general transfer balance cap has also increased from 2 million to 2.1 million. This is the limit on the total amount of superannuation that can be transferred into a tax-effective retirement phase pension. For some, we've intentionally delayed the commencement of a retirement pension to take advantage of this increase, and we'll be contacting those clients individually over the coming weeks. For others, even though you may be eligible to commence a retirement pension, we may be intentionally deferring this decision until we have more information on the proposed tax changes to trusts and also taking into account these changes to capital gains tax. This is so we can make an informed decision about taking into account your overall wealth and tax strategy, considering these potential changes. Another change commencing from 1 July is called payday super. Rather than employers being required to pay super quarterly, contributions will now be paid each pay cycle. This creates an important timing issue for concessional cap management. For example, SG contributions for the June quarter may continue to be received in July under the old rules, plus employer and salary sacrifice contributions made under payday super. Therefore, it will be important to review whether your salary sacrifice arrangements need to be reduced, deferred, or recalibrated to avoid accidentally exceeding the concessional cap. Finally, Division 296 also commenced from 1 July. This introduces an additional tax on investment earnings relating to super balances above 3 million, with a higher tax rate applied to balances above $10 million. The first assessments won't be issued until after 30 June 2027, so there's still time to plan for this. For many that this change impacts, as discussed, doing nothing may be the best approach, particularly with the negative changes for capital gains tax outside of the superannuation environment. However, for those affected, we'll continue modelling the impact and discussing the available options throughout the year and at your planning meeting. So that's it from us today. There's certainly been plenty happening over the past couple of months. As always, we'll continue monitoring these developments closely and we'll discuss any changes relevant to you at your next planning meeting. If you have any questions, though, in the meantime, please don't hesitate to get in touch. Thanks for watching.